So thank you very much for having me. This is a very interesting paper. I learned a lot while reading it. And of course, it's about a topic that is very kind of, close to my heart. I think that the existence of the informal sector is very relevant for emerging economies. So, I mean, given that we know that emerging markets have a large fraction of informal, unregulated agents, both in the productive and the financial sector, and that we also know that, after the financial crisis and in the presence of the lower bound, macroprudential policy has become a very important tool. I think the question that this paper asks is a very relevant question and very natural, which is, how is the optimal design of macroprudential regulation affected by the presence of an informal, or how they call it, unregulated sector or agents? So I think that the question is for sure extremely relevant. And I'm going to kind of start by giving some comments about the big picture, and then I'll dive into more of the details. And so starting with the big picture, I think that, and this is kind of more of a detail in terms of how the paper is written, so it won't be relatable, I guess, to you guys who just, saw the presentation, but it's more of my comment to the authors, which is, I think that, we know, as I just mentioned, that any type of policy in general is subject to imperfect regulation enforcement. And so it's not just macroprudential policy. And the way that the paper is written, it seems like, macroprudential policy in this dimension would be kind of unique in some sense. And my sense is, well, it's not necessarily unique, but if you want, you should make the point in some sense that, why is macroprudential policy so special in the way that you're kind of thinking about it, or how is it different from just thinking about other specific policies, like, for example, tax to labor income that are clearly evaded because it doesn't cover the workers in the informal sector as well, right? So I think that this is a very big topic, right, that you are addressing from one particular perspective, which is macroprudential policies. And so I think that it kind of has a scope that is kind of bigger from what it actually sounds in the way that is written. So I would kind of, frame it in a more general way. Now, and I think that kind of related to this, I would like to see kind of a tighter link between the motivation and the assumptions that are being made with the characteristics of the financial informal sector, because none of the assumptions that are being made are being motivated by the characteristics of these sectors in the different countries. So, for example, something that is very important is how backward is the financial informal sector in a given country. This varies from country to country. So we know that there are certain countries in which the informal sector acts as a parallel sector to the formal one, and segmentation is very small between the two sectors. However, there are countries in which segmentation between the two is huge. And so they are pretty much counter-cyclical, and there are very specific characteristics that they carry. And so I think that it's important to kind of bring the big the context of the sector per se into what you guys are doing that is very interesting. And so this brings me to the fact that, there are several things that you do in the paper. One of them is you design the optimal macroprudential policy when there are unregulated agents, right? But this relies on knowing what the debt level of the unregulated sector is. And this is an object that I think in reality is very hard to observe. So I think that it would require a discussion of, okay, what is BU? Do we have a good sense of what size does it have? Is it actually counter-cyclical with BR, so with the debt of the regulated agents? Or is it pro-cyclical, is the correlation positive or is the correlation negative, right? And I'm going to talk about this point later on, because this actually is one of the consequences that comes out of some of the results. And I think it's important to discuss it in terms of how counterfactual the results that are coming out of the model are. And finally, I would like to see a bigger connection between the 3-period model and the infinite horizon model, in the sense of what carries through, because we know that, of course, the 3-period model is pretty simple, right? And the point is to see with the infinite horizon model in a more general framework, how general the results that we saw in the 3-period model are. But this is something that is not, when you read the paper, it's not really clear. What are the results that really carry through? What is lost in the process? Why are some things that are lost? And of course, because there are big differences once you move from a 3-period model to the infinite horizon model. So those are kind of my big picture comments. So now let's move to the modeling assumptions. And I think that there are some that I think there are maybe some more minor, kind of worth thinking about, but maybe they're not kind of the make it or break it assumptions of the model. And then there are 2 assumptions that I do believe are very important for the results that are being obtained. So first, in the more minor assumptions, but that I would like to actually see kind of a motivation for why they're there, is first, why do agents consume only the tradable good in the first period? This is kind of, a detail, but I think, should be motivated somehow. Why would formal and informal agents have identical endowments? This is very related to what I mentioned at the beginning, which is, the 2 sectors in different countries operate in different ways. And a lot of times when we think about the informal sector or unregulated agents, they are less well off than Andres, yeah?
Yes, sorry to interrupt you, but it seems there's a problem with your slides. They're not moving.
They're not moving?
Can you reset them, please?
Yes, give me a sec.
I actually have noticed. I thought you meant to have that first slide, and then you just were talking about it, around it. But
Sorry, now I moved to several slides. Can you see them there? Are they moving or not?
No, I think they froze.
Okay, so I'm going to remove the full screen and see if they move in the there.
Now they're moving. Now they're moving.
There? And yeah. Can you see them? Are they big enough?
I think they're okay, yeah.
Okay, so up to which slide did you guys see, I guess? Only the very first one?
Only the first one, yeah. We thought you were...
Yeah, I think we don't really know that you showed. This
so only what, the motivation and question, or not even?
Not even that.
No, we were stuck in the cover. I thought you had that one slide and you were just talking.
You had a bigger introduction.
Yeah.
That's fantastic. That would be a humongous introduction. Okay, so I mean, I already talked through the motivation and question slide, of course, the big picture slide, and I was just trying to talk about the modeling assumptions.
Yeah, just keep
okay.
Yeah, good.
Okay, good. Thanks for letting me know. Okay, so about the endowments. So we typically have the sense that the informal sector is less well off than the formal sector, or is poorer in some sense. So how much does the assumption of identical endowments affect the results? And then in the 3rd period model, the taxes affect only initial debt, but not rolling over decisions. So this is something that, I mean, might not make a huge difference. As I said, these to me seem to be more minor. But still, I would like to see more motivation in terms of those assumptions. Now, let's move on to the ones that I do think are key assumptions and that would make a big difference in terms of the results. So the first one is the assumption of the Cobb-Douglas for consumption in the 3-period model. So there you relax in the infinite horizon model, you relax this by assuming a CES aggregator in consumption. But then in the calibration, it's not explored what the difference is when you have a higher degree of substitutability between tradables and non-tradables than when you don't. And I think that that degree of substitutability is actually very key for many of the results that you're obtaining. And this is pretty clear to see in the 3-period model. So that's the first thing that I'm going to kind of move forward to talk about. And then the second modeling assumption that I do think is key, and for me, this is kind of more problematic to say in some sense, is the fact that the fraction of the unregulated agents is exogenous. So you do have in the paper a section where you say, well, we can easily endogenize this fraction of unregulated agents by assuming a circumvention cost to being regulated. But I want to, talk more about this because in the infinite horizon model, it's still exogenous. And I think that this matters a lot for the results. So what about the implications of the Cobb-Douglas assumption? So we know that in terms of the mechanism of the model, a higher initial debt translates to lower consumption of tradables, and that translates into a lower price of the non-tradables for any income shock at date 1. So this is in the 3-period model. And this implies that from the credit constraint, this translates into a lower borrowing capacity and a tighter borrowing constraint when this constraint is binding. But what if there's a lower degree of complementarity between the tradables and non-tradables? And as I mentioned, this was allowed for in the infinite horizon model, but the implications of that were not explored. And this is a key mechanism within the model. So I was wondering, how much of a difference or how sensitive the results would be to a lower degree of complementarity between the tradables and the non-tradables, because this effect on the price of the non-tradables wouldn't be as large, I would say. And then the paper states that the mechanism behind the results is very similar to that of a limited commitment model. And I want to kind of contest that. I think that I don't quite see how that's the case, because in your model, an increase in total consumption translates into an increase into the price of non-tradables by omega over 1 minus omega times the endowment of the non-tradables. And hence that raises overall borrowing capacity by this term over here, the kappa times the omega over 1 minus the omega. And what this implies here, right, is that increased consumption relaxes the borrowing constraint. But when I think about limited commitment models, a tighter constraint increases consumption, right? Because what happens is that when you trigger the constraint, what the planner would like to do is, in order to keep you in the contract, they would increase your total consumption. And so this would go kind of against, the mechanism that you guys are claiming here that comes from kind of a limited commitment intuition.
Paulina, you have 2 minutes.
Yeah, perfect. So that for that. Then the other thing that is, kind of a little bit mysterious to me, to be honest, is proposition 1. And I would really like to understand what assumptions that it relies on. Because to be honest, I guess I clearly didn't have the time to kind of dig deeply into it to figure it out myself. But proposition 1 states the following. It states that for a given tax rate, the equilibrium borrowing of unregulated agents is decreasing in the amount of borrowing of regulated agents and vice versa. So you guys refer to this as a substitutability in borrowing decisions. And my interpretation of this proposition is that it seems like a crowding out phenomenon, which to some extent sounds counterfactual to me, because it means that if regulated agents have a higher indebtedness level, then unregulated agents will have a lower one and vice versa. And we know that this is not necessarily true when we think about the informal sector, because I do think that technology shocks are positively correlated between the formal and the informal sector. And if we think that borrowing constraints are affected by technology shocks, and they're positively correlated, most likely they would move in the same direction in the two sectors, and the direction in which they would move, that the level of indebtedness would be in principle the same. So I wonder, how counterfactual this implication is. So this statement is basically to kind of solidify kind of the statement that I just said. And then finally, how does proposition 1 translate to the infinite horizon model? The long run frequency of financial crisis is not increasing in gamma. So it's not increasing in the fraction of unregulated agents. And to me, it seems like it should, because we do know that factually countries with large informal sectors are more prone to financial crisis. And so this is why, I would really like to have a much better understanding of where, which assumptions proposition 1 is relying on, because it's determining a lot of the results that we're seeing. And some of them to me seem somewhat counterfactual from what we know happens in the informal sector. And finally, I'll quickly, yep.
All right, you are
yeah, I'll just quickly
minus 30
go
seconds.
through this, which is, this is the last slide. So we know that the informal sector responds to tax pressures, right? So we know that its size is endogenous. And so when there is a trade-off when deciding to operate informally or formally, when you're deciding if you want to operate informally, there's a trade-off, right? So the benefit is that you're going to pay no taxes because you're in the informal sector, but there's going to be a cost because with a certain probability, you're going to get caught and you have to pay a penalty. That's kind of usually the way that we think about it. And so when we think about endogenizing the size of the sector with the circumvention cost, for me, it's kind of, I'm not a big fan of doing it that way, just because you're losing this part of this trade-off part. I don't think that this is, like a make it or break it comment, in the sense that I think it will make a difference quantitatively, not really qualitatively. But I would also like to see the fact that in the infinite horizon case, you take into account that gamma can be endogenous, because in that case it's exogenous. And I think this is making a big difference for the event analysis results specifically. And some of the, the facts that the leakages are not powerful enough to overturn effects, So I think that contemplating the fact that the size of the sector reacts to taxes is extremely important to think about these issues.